All right, guys, welcome back again to Not Financial Advice. Last video of the week, and we're going to take a look at Kraft Heinz Company, ticker symbol KHC, starting over here on Qualtrum. A note about Qualtrum: it's a stock software service that I pay for, yet I have no affiliation with. If you would like to learn more about Qualtrum, I will leave a link for the software in the description below. But this is an interesting company, guys. It's Buffett long buy and hold. Lots of questions were asked of him about why it was that he had bought this company. There's some good things, obviously, a lot of strong brand value. Um, Kraft macaroni and cheese, Heinz ketchup, the other associated products that they have. We're going to see what the value of this stock is here in our fast DCF and stock review, but let's look at the stock price first over here on Google. So, if you would have bought this company when it became public, you would be down 28% since 2012. What if I told you I could put you in and take you out 11 years later and you'd only lose 28%? How would that sound? Not very good. So from all-time highs, the stock is down 66%. For a lot of people, if they bought at the wrong time, that's what we like to refer to as potentially total capital loss, or rather permanent capital loss. So anyway, we're down about 66% on this stock from all-time highs. Around this time when we were peaking at the price of the stock was when Kraft and Heinz merged to become one of the largest consumer package defensive food companies in the world. So would it be fair to say that the stock is extremely oversold? Probably. So from its very lowest price, there's been a gain of 48%, which is 2x the losses that people have incurred if they had bought and hold from IPO date. So since the peak of the COVID crash to today, the stock is up 48%, but overall, from all-time highs, it's down about 65%, as we had just shown you. Or that's annoying. Oh, while I'm fumbling with this, make sure to like, comment, share, and subscribe on this video. Now let's talk about the value of this company. So we're back on Qualtrum, and let's do a quick look at the relevant metrics first. So low PE stock, between 13 to 14 PE to forward PE. Free cash flow yield's pretty good, over 5%. We have almost $1 billion in cash, but almost $20 billion in debt. Not great. High starting yield at 4.9%. It's not a safe yield. It's at 63% of their cash flows are going to pay for dividends. That's not ideal. So let's look at revenue. So what's going on with this company? When we look at Kraft Heinz for all time, we can see sort of a lot of flatness. And this was the acquisition between, or the merger between Kraft and Heinz is what happened here. So prior to Kraft Heinz merging, whichever was the owning brand had flat revenue. They merged, also flat revenue. Okay, so this was where I really struggled rather, in doing our discounted cash flow evaluations for estimated growth, because we can just see a lot of flatness here. All right, and the only growth that they're having to pay for by issuing either equity or debt in mergers. And they've done some other smaller acquisitions in the international space and within the condiment category. So, I had to really go back and forth. We're going to take a quick look here. U.S. packaged food market is expected to grow at a CAGR forward for the next 5, 6, 7 years of 4.8%. But I'm just not seeing that with Kraft Heinz, unfortunately. So this segment is expected to grow at about 4.8%, but that's not what I'm seeing in the revenue growth from this company. So let's take a look at free cash flow on a stock-based compensation adjusted free cash flow price. And looking over the last 5 years, this number here is sort of the median, somewhere around 3 billion, 3 billion in cash flow, okay, on an annual basis. So it's just all right, not great. There is free cash flow here. That's one of the things that Buffett looks for when he buys, but just really not looking great. Share issuance, not great, being diluted. Their ability to reinvest in themselves profitably with either debt or equity. This is 10 years ago. That was a great number, but this seems to be the median here. Suboptimal, poor allocators of capital. So not looking super great so far. Lots of debt here for the purchase. So I guess they issued debt when they merged between Kraft and Heinz. They have tried to pay down some debt. But they still have a long way to go. And as far as any relevant information on buys or sells, we have someone who sold $400,000 worth of stock at a similar price a few months ago. So again, not very super promising here. Take a quick look at the price again, and then we'll discuss the value. So stock is currently trading at $33. And now we're over here, and we're going to take a look at some of these assumptions. So like I said, right around $3 billion average free cash flow last 5 years. So $2.9 billion in free cash flow a year. Total cash is nearly $1 billion. Total debt is nearly $20 billion. That's nuts. Shares outstanding, they're not doing a good job there. There's 1.24 billion shares outstanding. So I had a really hard time with this. You don't want to adjust your valuations to get to a number that you like. Last time I checked, Buffett still holds this, and so I think this is what Lynch would refer to as a turnaround play, and that's what people are looking for in this stock. So if you own it, you better hope that it turns around. I personally would not open a new position in this. I do hold a small position in this. Having done this level of research that I'm offering to y'all right now, I likely would not have opened it, but I will be holding. It seems like there's some sort of problem with management, some sort of problem with being able to reinvest profitably, some problems with debt. And so just looking at that, that research study that was saying there'd be a 4.8 growth CAGR in this category, I could only give Kraft Heinz credit for half of that, and I felt that was optimistic, right? And then I went ahead and had a terminal growth rate of almost nothing, discount rate of 10%. Current price of the stock is $33. I believe the value currently is somewhere around $12, unfortunately. Now let's play with this, because I think that valuations are both an art and a science. So if you were okay with getting a 100-year average historical return, I think it's something that could happen at this current price if nothing else were to change. Okay. So with the required rate of return of 5.5%, the stock is about fairly valued right now. But I think, we don't really want to be changing these numbers or these assumptions too much. And so I think the stock currently, if nothing changes, if it doesn't turn around, it's significantly overvalued. So let's just see what could happen if tomorrow, a miracle from God, they were able to, substantially cut their debt from 20 billion to 10 billion. It would still be overvalued if they were able to cut their debt in half. So they're going to need to either grow their growth rates, cut their debt, or do some other combination. But yeah, no matter no matter how you shake it, this one is not looking great. So make sure to like, comment, share, and subscribe. If you have any other stock you'd like for me to take a peek at, just leave the ticker symbol in the description below, and I will get to it as soon as I can, probably here in the middle of this upcoming business and trading week. So thanks for tuning in to Not Financial Advice, and I'll see you guys next time. Bye now.